Hi, Justin here from Eclipse Financial Services in Airlie Beach, Queensland. Here's another of our short videos on financial planning topics, and today we're covering the basics of investment. Most of us at some point in our lives will have to make some sort of decision about which investment portfolio we choose, whether that's in our superannuation or our pension if we're retired, or whether it's an investment outside superannuation. So this is just designed to give you a short snapshot of what sort of things you should be considering when you're making those decisions. Usually we'll be given a choice of at least 3 investment portfolios. Now they'll have different names. They could be called a conservative portfolio, which is a low risk portfolio, a balanced portfolio, which is a medium risk, or a growth or aggressive portfolio, which is a high risk portfolio. Basically, the difference between those portfolios is where your money is actually invested and the proportion of money you've got in each of the different types of investment. Effectively, there's only 4 major places in the world you can invest money. There's the cash markets, where your money's at call with a bank, building society or credit union. There's fixed interest markets, where your money's locked away for a fixed period and therefore you get a slightly higher return. That can be with banks, building societies, credit unions or government type departments. The third major market is property. That's covering everything from residential property through to shopping centres, high-rise office blocks, etc. And the fourth major market is shares, or the stock markets of the world, where you can invest in all sorts of companies that do all sorts of things. History tells us that of these 4 major markets, if you're only investing in the better quality blue chip assets, so the bigger properties with big tenants, the big strong companies that are brands that we recognise, not the small ones, government and fixed interest and cash investments with bank, building societies and credit unions that are low risk, not high risk, large institutions. Long term, if you look over 15 and 20 year periods, your returns from cash and fixed interest are fairly low, around 4 to 6%. These guys are called income assets because your return is interest income. When you look at the long-term returns from quality property and shares, your returns are much better. They're around 9 to 11% as a long-term average. And that's because you get an income from rent from property and dividends from shares, but you'd also expect good quality property and shares to grow in value over time. So getting capital growth as well as income, and that leads to the better return. So these guys are called growth assets. We need to talk about risk. Basically, if you're investing in good quality property shares, cash and fixed interest, and you've got a well-diversified portfolio, which most of our super is invested through managed funds where that's the case, risk is more about how your returns fluctuate from year to year. So down here you're going to get a pretty low average. Up here will be growth assets, a much, much better average over time. Down here it's going to be pretty steady. Interest rates go up and down, but you're never going to earn more than about 12%. You're never going to earn less than about 2%. Property and shares, your rent and dividends are pretty steady, but your capital growth can fluctuate quite a bit. So these do fluctuate quite a bit compared to these, therefore time frames are a crucial factor as well. So bringing it back to your portfolio choices, which may be 3 or maybe many more that fit in between these somewhere, a low-risk portfolio is only going to have a small amount of your money invested into growth assets and most of your money invested into income assets. Consequently, it's going to get an average return of around 5 to 6%. And time frame wise, a little bit of growth assets, you probably want a time frame of at least 3 years plus. Next up, you have a medium or balanced portfolio. That's got more exposure to the shares and property to growth assets, less exposure to the income assets. Therefore, its returns are going to be around 7 to 8% long term. And time frame wise, there's going to be more fluctuations, so you want a longer time frame, probably 5 years plus to look at something like that. And finally, a high growth portfolio is going to have lots of your money invested in the shares and property and growth assets and only a little bit over here of income. Consequently, the long-term average return is going to be quite good, up around 9 to 10%. You are going to get a lot of fluctuations, therefore you want a good long time frame. Time frame is something that's easy with, say, super, because we know how long till we retire, and then of course we want our money to continue investing for 10, 20, 30 years in retirement to sustain us. But that's a bit of an overview of how investing works. This is what we call general advice. We haven't looked at your personal individual circumstances, what you're working with, what your goals are. By all means, you should come in and have a chat to a financial planner, either by phone, Skype, face-to-face or email before you make any decisions about your situation. There's a lot more information available at our website, eclipsefs.com, and there's lots more videos, including a more detailed video on our investing box. Thanks for your time.